Hello, my friends. Today is July 31st, and this is my July FOMC debrief. So we just had Chair Powell's presser. What happened? Now, before we get into what happened today, let's level set a little bit. So the last time we had an FOMC meeting was in June, and June was one of those special meetings where we got a Fed dot plot. Now, through the dot plot, the Fed guided towards one cut this year, and they also forecast that inflation, their favorite measure of inflation, core PCE, would end the year at 2.8% year over year, and they forecast that the unemployment rate would be 4% at the end of the year. Now, between June and now, we got a lot of data, and it was very, very good from the Fed's perspective. Now, looking at inflation, core PCE is now printing at 2.6% year over year, so far ahead of the Fed's forecast. Looking at the unemployment rate, we've actually edged up above the Fed's forecast 4% and most recently printed at 4.1%. So if you're the Fed, you're making a lot more progress on inflation, and at the same time, it looks like the economy is softening a bit. So obviously, you have to be thinking about cutting rates. Now, heading into this meeting, the market was pricing in 3 cuts for the rest of this year, starting in September. Now, Chair Powell basically delivered on that, but let's get into what happened. Now, the first thing you get in a meeting is the FOMC statement, and the FOMC made a number of changes. Let's look at what those changes are. Now, when you look at the red line here, you notice that first, the Fed acknowledged that data has been softer than they thought. So job gains, instead of saying remain strong, they have moderated. And the unemployment rate moved up, although, of course, still remaining low. Now, something very interesting is that their commentary on inflation, in that instead of it being elevated, they've kind of downgraded it a bit to somewhat elevated. Again, acknowledging progress on inflation and also the softening labor market. Now, the most important change is the last sentence. In that last sentence, the Fed is emphasizing that both sides of the mandate are becoming important. Now, over the past 2 years, the Fed, being a 2-mandate bank, full employment and price stability, have heavily emphasized inflation side of their mandate. Now, though, with inflation close to 2% and the unemployment rate weakening, the Fed can't just emphasize inflation. Now that its 2 mandates are more in balance, it's going to have to think hard whether or not monetary policy should be the most restrictive it's been in decades. Now, the first thing everyone wanted to know at the press conference was, are you going to cut rates and when? And so Chair Powell, of course, knows this is happening, and so he began with it seemed like somewhat scripted answer about September. Let's listen.
On September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to 1 or 2 data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So again, Chair Powell, being a central banker, is never going to give you certainty. It's always conditional, it's always stuff like that. But they talk in, I guess, suggestions in very soft ways. Now, he mentioned September, and he basically says that as long as nothing really weird or terrible happens, we're going to cut in September. That's as sure as you will ever get from a central banker, and that is what the market acknowledges, and that's really what everyone in the market already thinks as well. So it's really no surprise. Now, something else that I thought was pretty interesting in this press conference was how Chair Powell characterized the change in inflation. Now, let's take a listen as to how he thinks inflation now is different than it was last year.
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1/4 of that. We had 7 months of low inflation. You got 1/4 of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter.
So basically, Chair Powell was saying that, yeah, last year we got a lot of disinflation, but that was just goods, and we couldn't always expect goods to go down, and then to deflation. That's not realistic. So he's saying that disinflation now is broader, and he finds that to be more comforting because it suggests that the disinflation process is more thorough this time, and so it's less likely to be some kind of head fake. So overall, I think this was a meeting as expected, not super interesting. Again, Fed inching toward rate cuts. The market right now continues to price about 3 cuts this year. And that is my expectation as well, as I've been saying over the past few months. The equity market, of course, liked this upcoming rate cuts. Also note, of course, that today it looks like we have some geopolitical risk in the headlines. And we also have Mag 7 earnings today and as well as tomorrow. So a lot of stuff happening, but as far as the Fed is concerned, we are on the path to rate cuts, probably 3 this year. All right, that's all for today. I'll be back on Saturday for Markets Weekly. Talk to you all then.